trading gold is one of the fastest ways to make money. If you know how to trade gold properly, you're going to make a lot of money in a short amount of time. But if you don't know how, you're going to lose money very fast. So in this video, I'm going to show you the exact strategy that I use to scalp gold. Before I explain this strategy, you guys must know how to trade basic things like support and resistance levels and Japanese candlesticks. If you do not know how, do yourself a favor and check out all the 20 videos that I have on my channel, which basically just explain all of this beginner stuff. I also want you guys to understand that gold can move very fast. It can go up in 1 minute and the next thing you know is going down. Alright, so it is super duper volatile. That's why you do not want to hold the trade for very long. You want to get in and out of the trade fast. With this strategy that I'm about to show you, you guys should be able to get in and out of the trade fast, like within 5 minutes or at most an hour. So the first thing that you need for this strategy is the exponential moving averages. You can see this blue line and the red line in the background, right? Those are the EMAs, those are the exponential moving averages. And then change the settings of the moving averages to 8 and 14. So these two are the 8 and 14 EMA. So once you have the moving averages, you only want to trade gold when it is either above the moving average or below the moving average. Alright, so like right here, when gold, the candlesticks are all above the moving average, that is when you want to trade gold. And if it's below the moving averages like this, that's when you want to trade gold. But if the moving averages is in between the candlesticks like this, you want to stay the hell out of the market. So if the candlesticks are above the moving averages, you are looking to buy only. And if it's below the moving averages like this, you are looking to sell. Alright, it's literally as simple as that. I'm not trying to complicate things for you guys. So the key to this entire strategy is big fat candlesticks. You want to look for these big fat candlesticks and then you get in, alright? And the bigger the candlesticks, the better. Because that means that there is a lot of pressure, right? There is a lot of selling or buying pressure in the market. So right here, when we saw these huge candlesticks, right, we could have easily got in around here and our stop loss would be pretty much just below this candlestick. And I want you guys to keep your stop loss as tight as possible. This is like a little scalping strategy. So you want to keep it as tight as possible. And then your take profit, you should always make sure that you look to the left. Alright, this is very important, guys. You want to look to the left to see where price stopped at. So price stopped at around here. So you can see there's this mini resistance area right around here. So you could have easily got in on this trade after price made this huge candlestick and just got out like right around this area here when price just went all the way back up and then wick all the way back down, right? Just get out. So this is one entry, or you can be patient enough to wait for the price to retest the moving averages like right here. You retrace all the way down to create your new higher low, right? You could also get in then. That will give you a better entry. So if you have entered right here, you could have caught over like 50 pips on this one short trade. This is like in less than an hour, dude. Less than an hour, 50 pips caught just like that. So another example would be right here. Once again, you saw your big fat candlestick and price is also below your moving average, alright? So you will enter right around here for a sell after price printed this big fat candlestick, right? And then once again, your stop loss should be above the engulfing candlestick, like right around here. Pretty tight stop loss. So you pretty much could have just ride this move all the way down here. And then once price did this huge green candlestick, right, just get out of the trade. Alright, just get out when you see price is reversing. So this is another 60 pips. As simple as that, guys. And you guys want to make sure that you get out when the candlestick is like making smaller and smaller. You can see right here, it went from being super big, right, to being smaller and smaller. This means that the sellers might be going away and there might be more buyers in the market. Remember, this whole market is mass psychology. Everybody is doing something. They are either buying or selling. Alright, this market is just mass psychology. You have to think about what other traders are doing. And if you see all these small candlesticks, chances are they have already taken profit. Alright, the sellers have already taken profit and the buyers are back in the market. So you should get out. And when price like pretty much retested this moving average and wick all the way back down, right, you can just keep moving your stop loss and just keep having a tighter stop loss. This will really allow you to minimize your risk. Big candlestick, get in and get out at where price stopped at previously, which is right around here. You can see this was even a 200 pips trade, just by combining all of these things that I'm telling you guys about. So when price is at a key level, even though price is making big candlesticks toward it, right, maybe you should not trade, because if it's at a key level that has not been broken past, it's going to reverse right here. Once price reaches this key level, even though it makes this big candlestick, it reverses all the way down instead. So make sure that you always watch out for key levels before entering the trade. This strategy might look very simple, but what matters about this strategy is your patience. You guys need to be patient enough to wait for the big candlesticks to form, because big candlesticks like this do not form every day, and you have to be okay with that. You have to wait for the market to present opportunity, then you enter. And please guys, do yourself a favor and never ever trade when the market is consolidating like this. I find myself losing the most money when I trade when the gold is just consolidating like this, because it can literally just go up, spike up, spike down, spike up, spike down, and it's not going anywhere. You are only going to lose money if you trade when it's consolidating. So all of these strategies that I just showed you, the moving average, the candlesticks, I have made a detailed video on each of them, and you can find them on my channel. And if you are still watching this, you clearly like this video, so go down and hit the thumbs up on this video. So to summarize everything that I just said, the first thing that you need to do is put on your exponential moving averages, and then the second thing is you should look out for big, fat, juicy candlesticks. And the third thing is that you only want to get in for the trade when you have your confluences, when you have enough confluences. And the final thing is that you should never ever trade when the market is consolidating. So if you have enjoyed this video, check out this video to learn how to trade gold the right way. And if you like the way that I teach, consider subscribing to the channel by hitting this round circle right here. And I'll see you guys in the next video.